Hello everyone, it's Davide here and welcome back to Learning Finance. In today's video guys, it looks like that we are going down a little bit finally. So we are gonna go through the fundamentals of FAAMG, which are the top 5 tech stock in the world. Okay, so Facebook, Amazon, Apple, Microsoft, and Google. We will go through the balance sheets of those companies, revenues, margins. So leave me a like if you like this video and leave me a comment below. Just tell me if you are interested in those kind of videos, so I will make more of them. And subscribe to the channel, why not? And let's begin. Alright guys, so now the market is still closed. Now this is the future of the S&P 500. It looks like today as well is going to be a negative day so far, so we don't know how we are going to open. If you take a look at the Nasdaq anyway, it's crazy. Okay, it's been crazy in those days. We had basically almost a V shape completed. Okay, the tech stocks went up a lot. So there is a lot of hype behind those tech industry and tech stocks. And I said, well, let's go and check it out which one is the best and which one has the most healthy balance sheets and which one can have the most upside potential during the next 5 to 6 years. Okay, so let's take a look. So here we are, guys. Amazon, Apple, Facebook, Alphabet, which is Google, and Microsoft. Let's take a look at them. Now we have Amazon, which in the year today it's up 28.26%. Okay, in the YTD. It has a high price of 2,475 and a low of 1,600 around. It is the one that is up more of them all. Okay, we have new highs on that one. Okay, it's the only one that has new highs in the stock price on that one, because with the lockdown, of course, sales has increased. So Amazon is a new high, all-time high, which is crazy. And after that we have Apple, YTD 5%. Facebook, which is almost at the same level. We started this 2020, just 0.37% up in the YTD. Google 1.22 and Microsoft 14%, which is a lot, okay, a lot. But let's go into some fundamentals here. Here we have the last year of balance sheets, okay, it's the entire year performance. And let's go to check it out, some margins, which are pretty important. So here we see that in terms of revenues, Amazon is the bigger one in terms of volumes, followed by Apple, and Facebook is the smaller one. Okay, is the smaller in terms of revenues. What's interesting here is the cost of revenue margin. Okay, which is very interesting. Now, when you see the green is the winner, and when you see orange is the loser. And we have Facebook, which basically 81, almost 82% of revenues are gross profit, while costs are only 18%, which is crazy. Okay, super great. While for Apple is not so good. Okay, costs are up to 62.18% and gross margin, so it's like below 40%. And also Amazon is not as good, okay, in that margin. After that we have the operating income, and here is where things become even more interesting, because if we look at the margin here, we have Facebook, which again is the winner. We have 33.93% of margins, and Microsoft as well is the winner. Sorry, basically they are the same. Okay, almost 34% of operating margin. So higher it is, better it is, which is very good. But Amazon, guys, look at that. This is super bad. Okay, just 5.18% of operating margins. To make you understand what that means is that take a look at that. Now, for Amazon, we have revenues of 280 billions. Okay, but when we go to operating income and net income is actually less than Facebook, which has almost 3 times less revenues. Okay, so that's a thing you want to consider. Okay, the margins of Amazon are really bad, one of the worst in the industry. Okay, net margin is even worse. So Amazon is the loser in that thing. Okay, absolutely the loser. And the best one in terms of margins is Microsoft, guys, followed by Facebook. Not bad for Apple and Google, but Amazon very bad in that way, okay, in that confrontation. So you want to keep in mind that. When you have margins so low, you don't have enough room to change and something and to make mistakes. Okay, if you make mistakes here, you have a loss. That's you have to be very careful about that. Okay, in a growth stock like Amazon with those low margins, if you make a mistake, the price can change very fast. Okay, while Facebook, in case of Facebook and Microsoft, it's wonderful. Okay, it's wonderful. More than 31% of revenues end up into be net profit, which is very great. Now let's shift to the next chunks of numbers. For those one, I took the last balance sheet, which are the end of March 2020, so the Q1 2020 earnings released, the balance sheets, okay? And so let's take a look at the health of those businesses with ratios and debt to equity, etc. So let's start with the current ratio, which, as you know, is the ratio between total current assets and total current liabilities, okay? And so the winner is, again, Facebook, followed by Google at that time. Facebook has a total current asset of 69 billions and total current liabilities of just 15 billions. Is absolutely crazy. One of the highest current ratio you are gonna see. Okay, absolutely wonderful. It has almost 5 times the assets than the liabilities in the short term, which means it's impossible to go bankrupt. Impossible. Okay, while the loser, look at that, Amazon again. Well, it's not bad because it's above 1, but it's really near to 1, okay, the ratio. Now let's take a look for the total asset and total liabilities. So the ratio here, we have, again, the winner, no doubt, Facebook. Again, it's crazy, okay, it's crazy. The balance sheets of Facebook is the best you can find. Absolutely wonderful. And the loser this time it's Apple. Okay, it's Apple and followed by Amazon again. Okay, they are above 1, so it's fine. Okay, it's still fine. No problem. I mean, they're not risk to go bankrupt, but if you compare with Facebook and Google, well, clearly they are better. Okay, clearly. And Microsoft is like, yeah, not bad, above 1.5. Let's take a look at debt to equity ratio. Debt to equity ratio, here we have the debt to equity ratio is total debt divided by stockholder equity, which is total asset minus total liabilities. Okay, and we have that the loser is Apple. Apple has almost 140% of debt to equity ratio, which means they have more debt than equity, stockholders' equity, okay? Followed by, again, Amazon, almost 100%, 97.65%, while the winner is Google, followed by, again, Facebook, Very, very low debt to equity ratio, below 10, which confirms what I said before. Those two companies, it's impossible that they are gonna go bankrupt. Okay, absolutely impossible. They are probably safer than the United States of America itself. Okay, it's incredible, especially now that Facebook has passed that problem with the data streams and things like that, sort of a scandal, blah blah blah. Now all that thing is gone. Okay, so it's like they are untouchable now with this balance sheet for real. And let's take a look at the market cap, guys. Market cap, we have 3 out of 5. They are above the $1 trillion, which is crazy. They are the biggest companies outside. Okay, Amazon 1,181,000,000,000, Apple 1 trillion.3, and Microsoft again 1 trillion.3, which is the biggest of them all as of today. The smallest one, Facebook, $500 million, 584 billions, and Google, okay, just below the $1 trillion. In terms of book to value, here is where you see that those stocks are growth stocks. Okay, the book to value here is calculated basically. You take total asset divided by minus total liabilities, and you have the stockholder equity in the balance sheet. Okay, so that's the equity, that's the capitalization in the balance sheet, while this is the capitalization in the market. So if you take the capitalization in the market and you divide it by the capitalization in the balance sheet, you have the book to value. And the book to value is telling you how much more the business is valuated in the market comparing to the balance sheet. In terms of Amazon, we have a book value to 18, which means that in the market, the company is 18 times more than in the balance sheet. Okay, so that's it. For Apple, we have around 17, and for Facebook, 5.5. The winner is Google, just 4.5, and Microsoft, 11, almost 12. Okay, so that Amazon and Apple are very growth stocks. Okay, are companies that are super high in values, and while Google can grow more and Facebook can grow more. Okay, because we can say that so far they grew less, okay, in comparison with Apple and Amazon. So conclusions, guys, conclusions. Which one of those 5 is the best? Well, according to the fundamentals, the best one, in my opinion, is Facebook. Is Facebook because of the balance sheet? Is Facebook because of wonderful margins? And it's Facebook because of the potential. Okay, the upside potential is higher on Facebook than in the others, because with the market cap was just $500 billion, 584 billion, you have more room to grow. Okay, to grow. While, for example, if you take a look at Apple and Microsoft, they are so big and so huge that, okay, they can grow even more, but probably Facebook can grow faster and more in terms of price action. Okay, absolutely wonderful, the margins of Facebook, absolutely. Second best, in my opinion, well, we have Google. In my opinion, the second best is Google. And which one for me is the worst in that moment? Amazon. Amazon, guys, in my opinion, right now is the worst in terms of upside potential. It's a company that has made crazy numbers during the last 10 years, and right now, for me, the upside potential on Amazon is less, a lot less than, for example, on Facebook. Okay, We have super bad margins, which I hate them. These are ridiculous, guys. Ridiculous. Very, very bad. A current ratio that I don't like it is too near to 1. If they make some mistakes, we are gonna go below 1, and there is not much room for mistakes here, okay? And book to value 18, it's already grew a lot, okay? So that's my opinion. The best one, with the most potential, is Facebook, followed by Google, guys. So tell me what you think. This is the end of the video. Leave me a like and subscribe to the channel. Just leave me a comment below with what you think about that, if you own those stocks, and see you in another video, guys. Have a wonderful day.